People will have this doubt whether we late to invest or whether we late to this generation to do something. See, if you ask me, nothing is late. Even if you are in your 70s, you can invest, you can put your money in your secured way, and each and everything you can do it. But only thing is the risk you're going to take will differ. So let's go deeper and analyze about this. What is the risk difference we are just going to get on this? Let's see a little deeper, because that's very, very important to see to it. Okay, first thing, guys, like if you're from like in your 20s, you'll have lot and lot of exposure to take high risk. Okay, and if you're like if you ask me till which age I can take more risk is till you're 35. If you're like till your 35 age, you can go with an higher risk model. Okay, so you can go with higher risk, but after 35 to 50 you can go with a moderate risk, and after 50 and above you can go with a very low risk. So I just classified into different ways so that you can move your money in a smart way and you can save for your future. Okay, so let's go deeper into this. Why you're saying your 20s can be you can take more risk and everything. See, in your 20s you will have a lot of time and you will have a lot of energy, so that you can take a lot of risk. How you can take a lot of risk is investing on the asset which is highly riskier, so that your return would be higher, and even if anything goes wrong you can have the proper edge to come out from that. So you have a lot of exposure in your 20s compared to if you are like 50s or something, because on that time you don't need to take more risk. You can take a less risk, you can go slowly inside the future. So taking the high risk, what are all the advantage? See, one thing, if you take an high risk in your life, your reward would be higher. For example, doing business, doing big investments, or doing investment on the sector in the small cap, and which is the new startups. You can invest on these things. So what it will do is it will make your money multiplied very faster compared to like other kind of risk categories. So first thing is let's go with the safer side of high risk. For example, in high risk, always I will say to everyone, don't put all your eggs in one basket. Split your basket into several pieces and invest on that, so that what will happen is you will know what exactly it's happening. You will know what exactly it's going through. If any issue happens also, you can easily come out with that if you have the multiple basket. Or if anything once goes wrong, something will take the portfolio to the next level. So for that only, the first thing is you need to safeguard in your 20s is your emergency fund, because as of now we are in the AI era. In this scenario, if you don't have 3 to 6 months of emergency, we don't know when they are going to fire you out of your job. We don't know when the things are going to collapse. We don't know nothing. So emergency fund will be coming at the top. And second one is destroying high interest debt. For example, like a lot of people, even I just seen, like as I told you, in your 20s, you can take high risk. You no need to worry. You can go with high yield bonds. You can go with small cap fund, or you can even buy small cap stocks, and you can go with the startup investments. You can go with these kind of high risk investments, so that if one thing clicks down, suddenly your portfolio will jump into 50 to 100x very easily. But the problem is, if anything goes wrong, if it's coming down, your portfolio can come down to zero or something like that. But the thing is, you can easily come out even if you come to zero, because you have a lot of time in your 20s compared to who's having in their 30s or 50s. But for them also, if they are willing to take more risk, they're also going to win. But everything will connect to mindset, because in their mindset they will have a lot of responsibility. After 35, you will be having your kids, you will be having your house, you will be having rent, you will be having lot of commitments. You need to take care of your family and everything. On that time, if you lose something, like coming out from that will take very longer time for you, because you are stuck in a commitment. That commitment will make you to push you forward, and it will push you not to take any risk. On that time also, you no need to worry. In any time you can do anything. Only thing is the risk which you're just going to allocate. For example, in your 30s, what you can do is, in your 30s, I'm just saying, after 35, what you can do is after 35 to 50, you can take a moderate risk. So 35 to 50, if you are in this category, what you can do is instead of taking high risk, you can go with Nifty index. You can go with like A category bonds. It's going to be A or A plus category bonds. You should not go below than that. And you can go with fixed deposit. These all will help you to reduce your risk. So you can split your money in a several ways so that you can push yourself to safeguard with a moderate risk, so that your yield will be moderate, your risk will be moderate, your commitment would be very, very smoother. So you won't stuck in any issue in these category. And if you're above 50, that's the time you will be having like full freedom to enjoy your life. So in above 50, don't take any risk. Put your money on gold or put your money on fixed deposit. So these things will help you to grow your capital in a lower riskier way. So you won't have any issue. You can go slowly in your life. You can spend whatever the FD you're just going to get as an interest. For example, if you just saved some money and if you put like around like for example, I'm just saying, if you have like $100,000, okay. So if you have $100,000 as an example, I'm just saying, like you can go with below or higher. And if you are yielding 5% on year, you can earn a $5,000. But with the $5,000 living in US, it would be very, very difficult. But the thing is, instead of putting all the money in a riskier way, you can save some money or put on you can minimize your risk. So that yield would be lower, risk would be lower, and in US, you can easily buy one house and you can yield more than this. Like monthly, you can yield 10 to 100. So you can even go with real estate. You can go with these kind of assets. But if you are in other countries, your real estate asset won't be much rental compared to what you are just going to buy it. For example, if you see India or some other country, if you're buying a house for $100,000, your rental income would be less than 3 to 5%. So instead of this, you can put your money on your FD or something. So this is the different scenario will happen. But if you ask me, in above 50s, you can take a low risk. Instead of putting your money in huge riskier thing, you can put in fixed deposit, you can put in government bonds, you can put it A plus bonds, you can put it bond, you can put it in top tier equity. Like you can split your money like on that category, you can put it. Even some people they are ready to take risk. On that scenario, you can buy real estate, you can invest on business, you can even go with a startup. Everything depends on your mindset. But a lot of people would be thinking, oh my god, I'm not going to take a risk. On that scenario, these are all the ways you can safeguard. So on your 50s, if you save a good amount of money, you can put in FD and you can happily move your life based on the capacity you have. So these are all the things you need to know. So that's all, guys. See, parking your money in each category of age, it's not at all difficult. You can put your money in any way. Only thing is the growth factor. Based on the risk you're going to take, the growth will be different. If you take a low risk, growth would be very, very low. If you take a moderate, your growth would be moderate. If you take high risk, your growth would be very high. So based on your risk category, you can go ahead with your thing. So that's all I want to say you. Like this, a lot of videos are to come. So stay tuned, guys. Bye-bye.